For the first time in over 60 years, the entire foundation of India's income tax law is being completely rebuilt. No, this isn't just a small tweak. It's a revolution in how your money is going to be managed. Over the next few minutes, we're going to unpack exactly what this massive overhaul means for your salary, your investments, and your financial future.
I mean, really think about that for a second. The rule book that has governed every single rupee you've ever earned has been around since 1961, and now, poof, it's being replaced with something totally new. So the big questions are, why are they doing this now? And what on earth does it mean for us?
You see, over 6 decades, that 1961 Income Tax Act just got bigger and bigger. It ballooned into this absolute maze of amendments and clauses, making it almost impossible for a regular person to figure out. The government's main mission with this new bill is to finally bring some clarity to all that chaos.
And this is the result, the Income Tax Bill 2025. It's now passed Parliament, which is a huge deal. This marks one of the biggest tax reforms in modern Indian history. And its goal isn't just to clean up the old law, but to create a brand new framework that's actually built for today's digital-first India.
The one key word, the big idea driving this whole thing, is simplification. The aim is to create a tax law that an ordinary person can actually understand more easily. The hope is that this will cut down on confusion, disputes, and the constant need to hire a professional for every little thing.
And the simplification is pretty drastic. They've literally cut the old law almost in half, slashing it from over 5 lakh words to under 3 lakh. But maybe more importantly, they're getting rid of some of the confusing jargon. You know how the separate previous year and assessment year always tripped people up? Gone. Replaced by one single easy-to-understand tax year.
Okay, so that's the theory. A shorter law sounds great, but how does that actually affect your wallet? What does this all mean for your take-home pay and your investment plan? Let's get into the numbers.
Right, this is where the changes are going to be felt by pretty much everyone. The new bill introduces a revised new tax regime with totally different income slabs and rates. And these will apply to the income you earn starting from April 1st, 2025.
So here's the most important part. You have a choice. You can stick with the old regime, with its whole web of deductions for things like rent and investments, or you can opt for this new streamlined regime. The trade-off? The new regime has much lower tax rates. We're talking just 5% on income up to 8 lakhs, but you have to give up most of those deductions. The whole point is to put more cash directly into the hands of middle-class taxpayers.
Now, if there's just one number you take away from this entire explainer today, please let it be this one. 12 lakh rupees.
Here's why that number is so important. Under the new regime, because of an increased tax rebate, if your annual income is up to 12 lakhs, your tax liability could effectively be 0. Now, there are a few exceptions. This doesn't apply to NRIs or certain capital gains, but for millions of salaried people, this is a real game changer.
And it's not just about your salary. These new rules also create a major shakeup for anyone who invests, significantly changing how profits from your stocks, mutual funds, and property are taxed.
This date is absolutely critical. The union budget announcements on July 23, 2024 basically drew a line in the sand. Whether your asset sale falls under the old or the new capital gains rules depends entirely on whether it happened before or after this date.
Okay, let's break this table down. For stocks and equity funds, the changes are pretty big. Short-term gains, that's on anything you held for less than a year, are now taxed higher, at 20%. For long-term gains, the tax is up to 12.5%. Though they did increase the tax-free limit just a little bit to 1.25 lakhs. The key takeaway here is pretty clear. Holding your investments for the long term is getting taxed more heavily.
Now, for property owners, the new law introduces a really interesting strategic choice. You can either pay 20% tax but get the benefit of indexation, which adjusts your purchase price for inflation, or you can pay a simple, flat 12.5% tax with no inflation adjustment. Which one is better for you? Well, that totally depends on how long you've held the property and how much inflation has gone up. Oh, and one keynote, this choice is not available to NRIs. They're facing the flat 12.5% rate.
As the financial planners at EnrichWise put it, smart investors can save thousands in taxes, while the unprepared may face unexpected tax bills. And that really gets to the heart of it, doesn't it? These changes create both huge opportunities and some serious pitfalls.
The new bill also has some very targeted changes for key groups that are crucial to India's economy. So let's look at the opportunities and challenges for startups and then the key reliefs for non-resident Indians.
For India's startup scene, this new regime is a massive shot in the arm. A new company can now operate on a super low 15% corporate tax rate for its first 5 years. You combine that with a tax holiday, and it means founders can pour nearly every rupee of profit right back into the business, hiring talent, building products, and scaling up. It's a very clear signal designed to boost innovation and attract investment.
Of course, it's not all smooth sailing. Founders will need to be really careful to navigate the complex eligibility rules just to qualify for these benefits. And there's always the risk of policy dependency. You know, what one budget gives, another could potentially take away, which makes 5-year plans feel a bit like a gamble.
For non-resident Indians, there's some very welcome relief. A big one is on property. NRIs can now claim 2 properties in India as self-occupied and tax-free, which finally ends that old, frustrating deemed-to-be-let-out rule. On top of that, sending money for family maintenance is easier since the threshold for tax collected at source, or TCS, has been raised from 7 to 10 lakh rupees.
So with all these changes swirling around, what should you actually be doing? I know it's a massive shift, but you can definitely prepare for it. Let's run through a quick, practical checklist.
Okay, start with your investments. Be absolutely meticulous about tracking your sale dates because that's what decides which tax rules apply. This is also the perfect time to reevaluate your entire portfolio to see what's still tax efficient. And if you are even thinking about selling a property, you have to do the math. Calculate your tax bill using both the 20% with indexation and the 12.5% flat rate to see which one leaves more money in your pocket.
And one final but super crucial point on the timeline. The new tax slabs for your salary, those kick in first, applying to the income you earn from April 2025. But the full, simplified income tax bill, that complete replacement of the old 1961 law, is scheduled to take effect a year later, in April 2026. So just remember, the changes are rolling out in stages.
So there you have it. The government's goal is simplification. But as we've just seen, the transition period itself is filled with complexity and strategic choices. This new framework definitely rewards long-term thinking and careful planning. The real